The conflict between the US and Iran escalated quickly through the spring of 2026. What started as localized exchanges has hardened into a prolonged standoff. For 2 months, oil tankers have been unable to safely transit the Strait of Hormuz. A massive portion of the world's energy supply is effectively trapped. While the physical blockade is confined to a narrow stretch of water, the financial shockwave hit emerging markets almost instantly. This single bottleneck is actively splitting the global economy in two, decimating some nations' finances while handing others a massive windfall. In India, panic set in as the rupee crashed to a record low of 96.20 against the US dollar. Indonesia is experiencing an almost identical freefall. The rupiah dropped to 17,670 per dollar, prompting the government to enforce tighter foreign exchange rules. But in Brazil, the exact opposite is happening. Despite the global chaos, the Brazilian real surged to a 2-year high. A war in the Middle East is crushing the buying power of billions of people in Asia, while simultaneously enriching South America's largest economy. To understand why, you have to look at the math behind how these nations power their grids. India and Indonesia share a structural weakness. They both import the vast majority of their crude oil. In India's case, nearly 85%. Oil is priced in dollars. As crude spikes above $110, importing nations sell massive amounts of local currency to buy dollars. Flooding the market with rupees and rupiahs dilutes their value. This imbalance creates a massive current account deficit. As local currencies lose value, international investors start to panic. They pull their capital out of developing markets and rush to buy U.S. Treasury bonds, a move known as safe haven demand. This sudden, massive exit of foreign capital acts as an accelerant, driving the local exchange rates even lower. To make matters worse, over 9 million Indians work in the Gulf. With the region locked in conflict, the billions of dollars in remittances those workers normally send home are drying up. When a country relies heavily on foreign energy, an overseas shock guarantees a currency collapse. The local money is drained to buy expensive oil, while foreign investment flees for safety. Brazil operates on the other side of this equation. As the world's 7th largest oil producer, it exports more crude than it imports. The blockade in the Strait of Hormuz has created a global energy shortage. This allows Brazilian producers to sell their crude and refined products on the international market at a steep premium. To buy that Brazilian oil, foreign buyers have to purchase the real. This heavy influx of foreign cash overrides the broader geopolitical panic, driving the currency's value up. Possessing critical physical commodities creates a financial shield. While other nations are bleeding capital to survive the supply chain breakdown, exporters are absorbing it. This dynamic creates highly volatile markets that react aggressively to even a hint of news. In early April, the U.S. president backed away from earlier threats, agreeing to a brief 2-week ceasefire proposal from Tehran. Oil prices instantly fell by 10%. Over in South Africa, a nation heavily battered by the energy shock, the rand immediately appreciated to its highest level as inflation fears cooled. But when the truce expired in May and the blockade held, the oil shock resumed. The rand plummeted right back down toward a multi-week low. Emerging market currencies have detached from domestic policies or local interest rates. Their value is currently dictated entirely by military updates from a conflict zone halfway across the world. In a crisis, an economy's resilience comes down to what resources lie beneath its soil and how desperately it needs foreign capital to function. Central banks are burning through foreign exchange reserves to slow the bleeding, but the financial damage inevitably trickles down to the average citizen. Higher interest rates make borrowing for homes or college tuition incredibly expensive. And because natural gas is crucial for producing fertilizer, the energy shortage drives up the cost of agricultural inputs, leading directly to higher food prices. In this hyper-connected global market, the physical security of a distant trade route directly determines the purchasing power of the bills in your wallet.